Hi, I'm Eric.
And I'm Dick. We're the Annuity Guys.
And today we're looking at income riders, that mythical piece that makes a hybrid annuity truly a hybrid annuity.
Well, Eric, everything has changed in the income world of annuities.
Yeah.
We've always looked at, for as long as time goes back, clear to the Roman Empire, that annuitized income.
Annuicide.
Committing
kill my
annuicide.
money. Kill my
Got
money.
to give all my money away and never see it again, but I get this income for life. And now we've got something that really has been popularized a lot by the hybrid annuity, which is really more of a marketing term.
Right.
But it's this income rider.
Right. And that's what the beautiful thing about an income rider truly is. You get the same benefits as you would, say, from an immediate annuity when you've got that income for life provision. But with an income rider, you've got income for life without having to give up that lump sum to the insurance company to commit it forever.
Well, and you keep what we've termed and coined our term
majority control.
Majority control. And so, and just to explain that majority control, which is a really simple way to understand it, is that when you put your money in an annuity, you basically control right from day one about 90% of what you put in just about every case.
Yeah.
So you could get up to 90% back. And a lot of times the surrender charges are given such a negative slant. What happens if someone puts their money in the market and the market drops 10%? That's just considered a slight correction.
Yeah.
So if you wanted your money back tomorrow and you put your money in yesterday and it dropped 10%, and I've seen clients come into our office and say, "This is what happened to me. I don't want that ever to happen again."
Yeah.
So so that surrender charge also, we should point out, has a declining aspect to it. So that your majority control increases year after year.
Yeah, typically most of them have that sliding scale where each year, and it's not always necessarily in the first couple of years where it goes down 1 to 2% each year, but you'll see it basically the longer you hold the annuity, the less the surrender charge is.
And the truth of the matter is that almost no one that does a well thought out income plan using annuities or balancing their portfolio ever surrenders it. And suffers or incurs that surrender charge. But it's always good to weigh that into the equation and make sure that you're doing proper planning.
So all right, income riders. Now you've got an income rider. You've added it to typically a base chassis of a fixed or a fixed.
Typically going to be a fixed indexed annuity.
Okay. So now, is there a fee? Well, some of them yes, some of them no.
Especially recently, there's been a lot of them that are coming out with no fee.
Now most of them typically are going to see a fee upwards, usually not over 1%. But
I think we've seen maybe 1.25 as the max, and probably the average is more somewhere around that 0.5% up to maybe close to 1.
Right. So now we know with your income rider, one of the things you get is income for life from it. You turn on your income. That income rider is going to give you that income for life guarantee. Now, there's a couple other benefits that are typically now associated with these income riders, and one of it's that roll-up provision is we're starting to see more and more.
Well, and this is what allows folks, to look into the future and say, I know that my income is going to grow. I know that I'm going to have a certain amount of increase in my income by a certain time period, where if I was relying on the market or external forces or the bank rates, which are so pathetic, I know that my income isn't going to grow.
Right.
But if I can have a guaranteed 6%, 7%, even 8 or better in some cases, that says my income account, not my actual,
not the cash,
not the cash I can get to,
right?
But the income producing amount of this annuity will continue to grow at an 8% growth up until I'm a certain age that I choose to turn that on.
Right,
that income.
And it's really the sizzle now that a lot of people and a lot of agents really like to hang out there is that, hey, I've got a guaranteed 8% for you.
They don't clarify it.
Yeah, they don't clarify, and that's what drives me nuts. Well, everybody always, can you beat 8%? Well, and this is the caveat. The 8%, like Dick has just explained, it's on, I term it the funny money account, where it's rolling up, and that's the number that's going to be used to set your future income for life.
Eric, it's great. It's fantastic.
It is.
Well, you don't need to deceive or confuse it with the accumulation account. Right. If your goal is income, guaranteed income, contractually guaranteed income, there's no way to beat it.
It's I call it the set it and forget it kind of mentality, where if you've got a roll up of 8%, you put this much in, in 10 years you're going to have a guaranteed income number starting in 10 years based off of that number and your age for life. And that's where the predictability aspect of that income rider comes in. And we like to use it, especially in a laddering sense, knowing that you can set it out there for 10, 15 years and know accurately what exactly it's going to generate.
Well, and Eric, this is the foundational part of someone's portfolio, of their income plan. It's what they can count on. It's what they can know is going to be there come rain or shine. And when you actually have that portion of your portfolio balanced and set up with those type of contractual guarantees, it allows you to take a few more chances if you're
with other dollars,
open to a little risk and to maybe beat in some of the inflationary pressures by investing more aggressively, because in a worst case scenario you've got your income covered for life.
Right, you've got the foundation taken care of, and that's what these annuities do so well. So, all right, now there's a couple other pieces that can be added on through these riders that tied together. Sometimes there's family endowment or legacy provisions within the income riders.
And another simple way to say that it would be death benefit.
Yeah.
That the income rider turns into a death benefit. So think about earning 8%, contractually guaranteed, and then so you didn't get to use it for your income.
Right.
Okay, it goes on to your heirs.
Now that's not universal. We shouldn't say that's not true with every company.
And it's probably less than half of them.
Yeah.
Maybe
a lot less than half.
Yeah, 20% or 10% of them. So there may be some trade-offs you have to look at before you even choose one of those.
Yeah.
But one thing that I should also point out is that in almost every case where that death benefit is paid out, as a death benefit, then they usually require it to be paid out over a period of time, a few years, 5 years.
5 years typically.
And it's not going to earn interest during that time period. So you want to be aware of that. That isn't such a bad deal.
No,
if you can earn 8% for 5, 10, 20 years and then turn around and take out that large amount of money over a 5-year increment so that you don't pay a lot of tax each year.
That's the key. It also doesn't have a big taxable implication.
Yes.
Easy for me to say today.
Yes.
So I think it's a very good benefit, especially when the companies have that option. Now, when you have got family endowment, well, what happens if you get sick, and maybe you need home health care or long-term care? A lot of times there's a rider or that tied to that, sometimes that income rider as well, where you can get maybe income doubled or tripled or multiplied, basically, is probably the best way to say it.
So if you've got your income turned on, you can use it for long-term care supplement, and it'll pay out double. Double is mostly what we see.
Common, yeah.
Now, the one thing that we also see are fixed annuities, sometimes fixed indexed, that will triple their value for payout for long-term care. So that it isn't just the income account, but you've got $200,000 in there. It becomes $600,000 to pay for long-term care.
Right, and it's specifically driven towards, those annuities are driven really towards long-term care.
Yes. Yeah. They may pay a little lesser percentage on the accumulation, but hey, you've got money sitting on the sidelines.
You didn't buy a long-term care policy. You're looking for a way
you can't qualify well for long-term care. Yeah. This is a great way to get long-term care.
So, and then the last piece that I think of as kind of being tied to the income rider quite often is the bonus. It's that allure to kind of, hey, if you get the rider, guess what? You get a bigger bonus. So it's only 5% normally, but you get the rider, it's a 10% bonus, which never hurts.
No, because it starts earning on that 8% roll-up right away.
Yeah.
And then if you've got a death benefit built in, even the better. So there's just so many factors to these new riders, and they're very innovative. Nothing like your father's annuity.
Yeah, that's right. Yeah, this ain't your daddy's annuity. That's very true. So, did we cover most of the things that have to do with income riders and confuse just about everybody out there? I think.
Well, I believe we've covered most of it, Eric. I'd like to point out, folks, some of these income riders do have increasing income ability. They have cost of living COLAs tied to consumer indexes, so that's important. Another thing that's really creative is working with an advisor that understands how to utilize a Roth IRA, and perhaps put your income rider, your annuity, into a Roth and have tax-free income for the rest of your life. So there's just a lot of good things that can be done, and Eric, we've probably just scratched the surface
Oh,
here.
that's true. It never hurts to talk to somebody. If this is something that you're looking at as far as a hybrid annuity or something that has an income rider provision, definitely make the phone call and have a conversation.
Yes, and work with an advisor that is very familiar with this, that specializes. Don't cut corners, and do your research, but then work with someone that knows what they're doing.
I agree.
Thank you.